Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of sitting with Patrick Karim of Badcharts. How you doing today?
Hi, Daryl. I'm doing great, man.
That's good. That's good. So you've been on the show quite a few times and everything. This is my first time getting to know you, getting to interview you. But I was reading about your background in psychology. And so I want to start there. I have a background in sociology as well as criminal justice, and had to work with a lot of people over the years of my life in terms of human nature, human behavior, and human psychology, and so I want to start there because there's an element of that relates to the market. The psychology of selling everything on when everything's red, when there's blood in the streets, everybody runs one way, or when there's a bull market, everybody's running towards the bull chart or whatnot. FOMO, fear of missing out. There's a lot of psychological elements. And so I want to start there. Could you share a little bit about your background in psychology and how that relates to what you do today?
Sure. Well, yeah. So, first I'll just go just a little further back there. So I'm in high school and don't really know what to do graduating from high school. Okay, what am I doing next? I didn't quite know what I want to do. So I saw that I had good grades in math. So I did they call it a college diploma in the commerce. So it's like social sciences plus mathematics. I did that for a couple of years. Then I still didn't know what to do. Man, it's crazy. Like I'm going through school, I'm doing stuff, and okay, well, I guess I have to go to university. So what am I going to do? Then I just look at my grades, and then I see, oh, look, I did good in psychology when I was in college. Okay, I'll go for a major, get a back in psychology. So I sign up to Concordia University. I start doing the program. I go through courses. I can't say it's the stuff that I learned. I learned some stuff at the university, but it's more maybe my inner person. I'm always looking for to try to understand, and how to read a room. How to I also like playing poker. So I'm always trying to be in tune to understanding like how humans react. Because university, was a funny story is halfway through my university, after a year and a half, I was arm wrestling with one of my friends, and I beat him on the right just for the bragging rights. But after that, we tried the left, and he lifted, like my arm broke in half. I heard crack. I thought the table broke. It was a wooden table. I said, man, the table break, but that was my arm broke. So after that, for a few weeks, I had the cast. I wasn't really going to my classes at university. And then I just, I said that maybe that's not quite for me. And then after that, I went into IT, right? It was just starting in 98, 97. There was I did a college diploma in IT. So yeah, it is on my resume there. I went to university in psychology, but it just happens that I'm naturally a person inclined that, to figure stuff out, to listen to people, how they ask questions and all that stuff. Always asking questions. Essentially, Daryl, that's a good point, because essentially chart trading is about asking questions. It's always trying to understand, yes, the price is trending upwards, but what happened before the price started trending upwards, right? And after that, you get to, you see the chart, you see the price action, but then with another lens, you see how the people are behaving. Like you said, the FOMO. Oh man, this is crazy FOMO, man. People are saying, your waiter's telling you about, giving you tips, your cab driver, everybody's giving you tips. Your grandma's talking to you about Bitcoin. Oh my goodness. But then I'm looking at the chart and I'm trying to scientifically see, okay, what's happening to the price? And then we'll show you your viewers there. Oh, look, I'm super stretched from the moving average when this FOMO, like this headline news starts happening, when CNBC starts talking about, oh, you should buy gold. Then I see I'm super stretched from the moving average. So I was able to use a scientific method and the emotion driven, FOMO, the crowd. And usually the crowd, they get in the last 20%. They might, or even closer. So they need a lot of price action for them to jump in, and most of the time they're closer to the end than the beginning. Just like, if you let me rant just a little bit more.
Yeah, go ahead.
For people to get into a stock, if you don't look at charts, if there's no story, you're not really going to believe people. They need a story, but to get a story, for the headline news to create a story, you need price appreciation. People are not going to talk about something unless these contrarian channels, maybe like on VRIC, you guys have been ahead of the curve, like covering maybe the metals. But before CNBC talks about something, they need to see the price go up. Oh, that guy made X amount of money. Then you see the influencers. Oh, I made whatever. I have a Lambo now. I made these life-changing gains.
Yeah.
But they're talking about past gains, and then you're there and you want to reproduce that, and then you're the FOMO because you're jumping in stretched. Then you have to look at the charts to see if you're actually stretched, because sometimes FOMO could keep extending. But ideally, the best trades is when it's a wasteland for many, many years, and then the price is starting to break out, but enough to get technical breakouts, a new uptrend, but not enough for anybody to cover, right? Like 50% off a bottom. Nobody's really going to talk about that. And that's when you get the greatest gains. You need to bounce off a bottom, 50, 100% off a bottom, but then you ride 100% to 1,000%. You ride that, right? You don't get in when a guy's bragging that he made 1,000% in uranium. You get in when it's just starting off, and then you be that guy who runs it all the way to the top.
Mm-hmm. Yeah, a lot to unpack there. Yeah, appreciate you sharing that. I mean, during the pandemic, there was a lot of expert traders, right? The Fed was printing money like crazy, like drunken sailors. And then everyone was making money. Everything was going up, and you saw many people, pop out on YouTube with YouTube channels. Everyone became a financial expert, because of those gains, and they drew a lot of people in. And then there was a lot of pain after that when interest rates started to rise. So, you mentioned that the 20 people typically get in the last 20% of a move. What are you watching typically with institutional behavior? Because institutions, typically the hedge funds, they typically move the market from my understanding of technical analysis. And then the retail investor come in typically after or late, and then sometimes get the rug pulled on them, and institutions are looking at certain levels and such. Is that something you pay attention to when you're looking at the charts?
Yes. So the way I break it down is I kind of have an out. I always tell myself the chart is the aggregate of all market participants, right? The institutional guys, the pension funds, the retail, everybody, eventually they have to pile in, they put in their money, and that's the chart. The funds, the macro capital flows. Maybe I should share my chart here just to show people how this plays out in the. Okay. All right. Here's my Twitter feed. I'm just going to show you guys how these macro capital flows carve out these charts. Which one should I get here? Okay. Yeah, here. I'll put here. This is a classic one there, because I always get Bitcoin's a commodity. Bitcoin's different. So right now, what I have here is the stock market, the SPX since 1997. And after that, here I have Bitcoin overlaid on top of it. When the capital flows, so the hedge fund, the big money that goes in, it fuels everything, right? Everything goes up in uptrend. There's bullish news, bearish news along these uptrends. And the capital flows, it's not the retail carving out these charts. It's just the money like coming in, overwhelming the shorter term volatility there. It's just creating these beautiful uptrends. And then those capital flows that come out, and through the hedge funds, through the pension funds, and all that, they're carving out these charts. So you don't want to fight that. You don't want to fight these huge capital flows. Maybe I have a better example here. I'll show you this one. I have to find my my pin chart.
Yeah, that's important. I mean, there was a lot of talk about don't fight the Fed, for a while, when the Fed was printing money, and many bears got squeezed out. And then the same thing with institutions, when you have, billions of dollars of capital, flowing in and out. Like, that's a trend that you don't want to fight against as an investor.
Here you see, Daryl. So this is a chart from 1910. And right before I get into this, I have to tell people sometimes, like the skeptics, they say, well, Patrick, who cares about the price in the past? Well, think about it this way, guys. in the present, me and you, some people, we're gonna take decisions, right? We're either gonna short sell, we're gonna buy. In the present, I'm doing an action, but because this is a price chart and it's for every buyer, eventually I'm gonna sell, right? I could sell in 10 years, 100, 50 years. I could sell in 1 month, depending on if I'm an institutional guy who has a longer time frame, if I'm day trader, swing trader, etc. So whatever I'm doing today in the present, eventually on the chart, I move to the left, right? Whatever price point I move, there's new data series that comes in. I'm an eventual seller. Like, let's say I bought whatever price. So a present day action bakes in a future action. So that's why charts are important, because like here I have the base. This is the gold versus SPX chart. This is critical because these tidal waves, when they change, here it's the monthly chart. I'm above a 84-month moving average. When gold outperforms SPX, it changes everything, because that means silver is going to go up, oil is going to go up, uranium is going to go up, copper is going to go up, and SPX is just going to drift sideways when this happens. And we had here the same here. We call it capital rotation event. We had in the 2000s, 2002. The SPX went nowhere, right? For 10 years, right? 2002 went down. Then after that, it went back up to match its peaks in 2007, 8. Then it went back down. Then it's only in 2012 or 13 that it finally broke out. But in the meanwhile, gold, silver, everything just outperformed, right? This is gold's performance versus the SPX. So these capital flows, you can't fight them. And goodness, I lost my train of thought.
And for this chart here, when gold goes up, the black line S&P, that means that gold is outweighing the S&P.
Yeah, it's outperforming. So let's say I'm forced to have a portfolio, and I say you could hold either gold or SPX. Then when you see that chart going up, that means you should be holding practically just gold, because you're outperforming. Why would you hold the SPX during these moves up? And on the contrary, on the inverse, when gold breaks down versus SPX, why would you hold gold? Like during this drawdown, because the SPX is just outperforming gold. It's these macro capital flows, and these are carved out by these institutions that take time to decide. Like once an institution, they have to go to the board of directors, they have to get disapproved, and they're looking at their numbers and they're not getting the returns they want in the stock. So they're starting to add commodities or alternative plays and stuff like that. Once they start turning that ship there, my goodness, you can't fight that, because for a decade, they'll make these alternative investments like gold, the miners, all that stuff's going to outperform on these ways up. And look what happened here. This chart I did a while back, but gold's actually above now a longer term moving average. So this is objective and mathematical, unbiased. It's starting to be above now a moving average. And as long as it stays above, we're in a kind of a new paradigm shift where gold is, right now gold is going sideways versus SPX, but gold potentially has a new uptrend going up versus SPX, and that changes everything. Because then after that, you look, if you're wondering why the silver chart's going up, so look at this, guys. Here's gold. I'm going to do it live. Here's gold versus SPX. I'll put it on the monthly. So that's gold versus SPX, guys. But if you notice, a whole bunch of charts, they track this, right? If I put the silver chart on top of this, new price scale, log scale, look at that. Remove that. Silver goes up alongside. So when there's a bull arrow, when gold's outperforming SPX, silver goes up. When gold's underperforming SPX, silver does not like that. It either gets headwind, goes sideways. Here, silver's greatest runs happen when gold is outperforming SPX. And then again, once again, we're here. Gold's starting to move up versus SPX. And guess what silver is doing? Silver is going up. And I could overlay the miners on that. I could overlay oil on that. That's why people got to look. I'll overlay oil. People they got to step back there when they start. Oh, like when I hear people say, "Oh, it's manipulated," and like all that stuff, guys, it's counterproductive. Like if you want to go back to the emotional aspect, look, you have capital management, your actual like NAV value, Daryl, but you have also emotional management, and people never considered that. Like I don't know if you've ever played poker. Emotional management is critical, because remember, a poker player, if he starts losing his capital, what's going to happen? He's going to go on tilt. That's his emotions. He ran out of mental fortitude, and then he can't see clearly, right? He said, "Oh my God, it's like I'm losing money. I have to do a double or nothing to catch up." Like we've all been through that. So what you got to do is you really got to focus on what's the charts are telling you. And look at that. Look at oil. Even oil. Look at the greatest run of oil ever had in the 70s. Goes sideways when gold underperforms SPX, but when the capital flows go back into gold, so gold outperforming SPX, it's not just gold going up on its own price chart. Gold has to outperform SPX. Then look at that. Look at the oil chart, how it tracks that. So right now, this little thing that's happening here, there, I'm going to zoom in for you guys. This little thing that's happening on gold versus SPX is super important. And here I have a technical line, a valid trend line, 1, 2, 3 reactions with wicks here. That's the sellers coming in. My goodness, if that breaks out to the upside, there's a high likelihood that the SPX is going into a bear market. There's a high likelihood that oil is going to go up, silver is going to go up, continuing to go up, copper, etc., platinum, all that stuff is going to keep going up. But that's why I tell people we're so early. I'm just going to show you this chart right here. I pinned it because it's important. This is that's even silver versus SPX. Silver hasn't even broken out versus SPX yet. And the greatest bull runs, the bull eras for silver are when it outperforms SPX. And I'll add this little tidbit. Bull markets, guys, from my point of view, a bull market is essentially just a price, something priced in fiat going up above a 1-year moving average, a 3-year moving average, just a standard bull market, right? Price is trending upwards in a meaningful way. A bull era is when price is trending upwards in a meaningful way, price in fiat, but also price is trending upwards, price in another major competitive asset class. So here, if you measure silver in SPX, silver is going up in price, but silver is also outperforming the SPX. So it's a double whammy. That means the capital flows that are coming into the markets, they're going to silver, rising its price, but they're also going more in silver than the stock market. And look at that. People forget that the SPX lost practically, I don't know, like 90% of its value priced in silver in 10-year period from 2000, like even here, 2001, all the way to the peak here in 2012 or 13, 12. The stock market just severely underperformed. You could have just held silver and you would have had this outperformance versus the stock market. And so that's why I'm telling you guys, even if silver's now is at 35, 38, 39, 40, 50, whatever price it is, we haven't seen anything yet to what's going to happen next once we break out of this breakout line here. Once gold breaks out here versus SPX, it's nothing. It's small potatoes.
Timing is everything in this business. We've seen commodity prices really move up. The copper price, that started to move up strongly. We're not far off all-time highs, although you wouldn't know it from the junior sector and copper companies in general. But I think over the next year or two, we're going to see that really correct to the upside, and you're going to see a lot of money come into the sectors. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. If you want to learn more, you can find us at vizslacopper.com.
I was seeing gold is kind of hitting that resistance within the cloud over there in the red. And then, right now it's reached this, this is gold, gold overlay with the SPX. So I see that it keeps hitting that resistance line. So we're looking at, it keeps testing that line. And so eventually, it's probably going to break out. If it, it's going to break through that at some point, right?
Well, yes, because when you look at the balance, the weight of evidence, there's too many things happening now to think that will not break out. So you don't front run it, but yeah, 1 touch, 2 touch, 3 touches. Look, you got to be bullish. The only reason I would say, okay, Daryl, the odds are of gold not breaking out above this line eventually is if this some type of rising trend line fails, and then I say, oh, okay, just like it happened here. See here in 2020 when the crazy FOMO, I was super bullish. You go to my Twitter feed here. I was like, this could be it. This could be it. But you know what? It's like with hindsight, you see the chart morph. You see the actual resistance, the meaningful resistance. Like as a chart trader, you try to. A good chart trader is going to figure out probably where the best resistance is, but it's not 100%. Sometimes So, okay, that resistance, with hindsight, the market has told me this is important resistance. And the more touches we touch, the more resistance it's important. And the more important it's resistance, it's also the more important a breakout line. So here it failed. So, okay, what happened when we failed that rising trend line here? We just went into a purgatory period. Now we got another shot of glory. So now that resistance is 100% morphed into existence. This trend line is 100% valid. So now, as long as you want to see this happen, like in the next, the next year there, you want to see a breakout here the next year. You don't want this to fall, because if it falls again, then with hindsight, I know that people they always want to see the bullish, like let's say I bought gold, I want to see this arrow. But if you're truly honest, this is what we could be seeing actually, right? It's still in the downtrend. Like it's starting to go sideways. It hasn't, like it's trying to go upwards, but it's gone from a time frame perspective. We've gone sideways for many years now. But it could still do this, Daryl. Like that's a low risk. If you tell me the odds of going up versus down, right now I have to say at least 80% that thing's breaking to the upside, at least. And this bearish scenario here, it's like 20%, probably even lower here. There's so many things not going in favor of the stock market right now. It's just like check out. You have to see this chart here. There, I posted it. It's the yields. We could do a little. Check this out here. This is just crazy. This is the 10 years, the 10-year yields and the 2-year yields on the same price scale. Whenever they hog together, whenever the 2 years and the 10 years, they stick together, it's like a power mode for the stock market. It does great, or for at least for the business cycle, there's no risk. As soon as the 2-year starts detaching itself from the 10-year, so essentially the 10 minus the 2s, it starts rocketing upwards. That's when you're vulnerable for a recession here. And after that here, when they're hogged together, that was one of the greatest bull runs here for the US stocks. And as soon as they start detaching with the 2-year like plummeting, it's like the bond market telling you, hold on, this is recessionary pressures. And even the 10-year yield getting a little bit of that longer term inflation expectation sucked out of it. Huge recession. And at these recessions, these business cycles turnarounds, the market doesn't have to go down, but it usually goes down. And if ever there's cracks in the armor of the stock market, let's say it's super stretched from its moving averages, that's where you get a lot of damage. And that here was a dot-com bubble. Here again, here's a beautiful reflate. This is when you want to be long the stock market, when the 2s are rehydrating, re-going up, even silver, everything goes bonkers when the 2s are going back up, right? Because that's recession fears. Nobody cares, right? That's they printed the money, whatever they need to do. When they hog together, everything's going great. But again, you see 2008 crisis, how the 2s detached. And the best time to get in the stock market was, again, 2011-12, when the 2s started going back up. And then after that, when they start falling apart together, detaching, here you got the COVID one. But look what they're happening today. The 2s are below the 10s. It's marginal so far. But the 2s, if they keep accelerating, they could vomit at any moment, just like they did in 2008, just like they did in 2001. It's not a setup where I tell somebody that you're in, it's coast is clear and this is the best time ever to buy the stock market. It's just not. With that setup here, it makes me very itchy. Now the stock market could keep going up, but is it at a low risk entry point? 100% not. Here, look at this one. This is SPX versus currency in circulation. I know we could do the M2. I have a chart for the M2 for you just after that. So here's the currency in circulation. I use that one because it has a longer data series than the M2. It's not quite the M2, but it has a longer data series. Bottom left to top right. So if the theory is that they just could print and stuff goes up and up and up, it's not true. It's the relationship of how much have they printed versus where the stock market is. Here you have the great the bubble of 2029. It went crazy high, then it imploded versus currency in circulation. Here you have the echo bubble. Here's the Nifty 50s. Stocks could do no wrong. They started plateauing. Then once they broke down in a meaningful way versus currency in circulation, that was a bear market for the stocks. They underperformed inflation. Until 1980, they underperformed gold, silver, uranium, oil, all that stuff. Here, they rehydrate, dot-com bubble, losing a rising trend line. And with hindsight, that was a dot-com bubble. Again, On the way down, gold, silver, all that stuff goes up. Then on the way back up, they do fine. But look where we are again.
Mm-hmm.
From a stats perspective, okay, yeah, sure. Some people, they look at that, so okay, maybe we'll have a 1929 moment. Okay, fine, but that's probably an outlier. We are 100% in bubble territory. I consider, like, if you look at all the data points, 80% of the time or 90% of the time, gold SPX stays within that dashed line there. And whenever we're in that blow off territory, so yes, the bubble has not been broken, but it's
really quick.
The setup's there for that.
So how do you factor in and just to kind of devil's advocate, folks are saying that, okay, well, when things break down, the Fed is just going to print and assets are going to continuously go higher because of the amount of printed money, devaluation of the dollar and such. And there seems to be a lot of market distortion, especially since 2008, where the Fed came in doing quantitative easing and such. And so how do you factor that in with that last chart, which I know the last chart wasn't M2, it was currency in circulation, and it continues to trend up, and you're still having these booms and busts along the way. But how do you factor that in when folks have that perspective?
Yes, and I've seen, and a lot of people have seen that global liquidity chart with Bitcoin, and there's like a 6 weeks delay, and they overlay that. It looks perfect. But as a statistician or like a chart trader, I zoom out. So here's the M2. Again, the M2 bottom left to top right. And here I have the distance from the 36-month moving average, and that's important. The market reacts whenever you have data series that go from bottom left to top right. The market reacts to the ebbs and flows, the accelerations and decelerations in that ever continuing fiat purchasing power destruction, because they keep printing. And here's the distance from a moving average for the M2. And here at the bottom, I have the SPX. And I just want to show people how dangerous a game it is, because right now there's a correlation with M2 and the stock market, or M2 and Bitcoin. If you look back at the data series, there's in the 70s, there's periods where the M2 was going up, but they're not the momentum was going sideways. SPX went great. And there's periods here in the 70s where the momentum, so the accelerations and decelerations of that ever going up M2 money supply tracked very well the stock market there. It's like every time it was up, like it tracked very well. In the 70s, it followed that. But then look at this period here in the 80s, the greatest bull run ever for the stock market. And money supply was actually not decreasing, but it was actually, they were printing less and less. So the momentum was actually slowing down. Look at that. Man, great stock run for the bull market. Here it went up together, but here, look, money supply went up. It did not stop money supply, the momentum, right? The accelerations versus its moving average went up. It did not stop a bear market here in 2001. It did not stop a bear market in 2009, the 2008 GFC. Here again, look, money supply contracting, not contracting, but the momentum slowing down. Look at that crazy run we had since 2012. So the lesson here is, guys, you can't trade off the correlation, because correlations, they're not always there. And what that tells you, when you don't have a correlation that's always there, it means there's another moving part that you haven't thought of. You know how we keep learning, Daryl? Like every day we learn something, right? We look on Twitter. That's happening. Somebody presents an interesting data. But if you go back to the psychology aspect, if you know that you learned something new today, and now you're starting to make decisions based off that new info, what's to say you're not going to learn something new later that's the opposite, that's going to drive the price in the opposite way than what you think, right? It's because when people buy stuff, they automatically seek bias confirmation, right? If I bought gold, I want to see the podcast of Peter Schiff, whoever's going to tell me it's going to go up, right? Because I have to justify to my wife why I put like our life savings in gold, right? Or Bitcoin or wherever it is. But you have to assume that there might be an Arab sheik there who has trillions of dollars that's hedging. He has the opposite position of you. You don't know. Like maybe he's not talking about CNBC. Maybe Ray Dalio's offloading stuff we don't know about. Like there's stuff we don't know. But the chart is all of that put together. And if a correlation doesn't work out and you're trading off the correlation, expecting the price to go up, you might be in trouble. So the best advice is just follow the actual price chart. If the price chart is actually going up, then that's all you need to know. Who cares about the narrative? There's a famous chart trader, Daryl, is Stan Weinstein. I read his book. Like, it's the first TA book I ever read. And I said, oh my goodness, this guy it makes sense. Stan Weinstein, he starts the first chapter, second chapter. He says, in the 1980s or 70s, nobody wanted casino plays. All that, the casino market's terrible. Nevada, Las Vegas, it's all horrible. All that stuff's terrible. Don't put your money there. But he was looking at the price charts. They were starting to move up. Like I said, they were crossing like a beautiful breakout line. They were starting to trend above inclining 30-week moving average. He says, man, I don't care what people are saying. Somebody's putting in money in here, making the price creep up above important levels. And that crystallized in my head. I said, yeah, he's so right. Like, who cares about the news? You will get whipsawed. By the time somebody talks about something, it's because the price went up, and it's like, it's not too late, but you're not there at the lowest risk and highest reward place.
Yeah, definitely. I think we should. A good example of that is the copper chart here recently. I love to look at that, and just want to. So obviously, folks they tend to get confused with, like gold, for example. Like, as a technical trader, oftentimes technical traders aren't like technically trading physical gold. Unless you're like a bullion dealer or such, and you're collecting the premium off of the rise in the price. Technical traders are often like, okay, whether that be options on miners and earnings or shares or whatnot, they're typically trading like the miners or the GLD or things of that nature. And so, like, there's a separation between like gold as money and gold as like a trade where you're trading like ownership of a company for,
Yes.
And so it's good to like separate that out. But then also just thinking about like inflation as a whole and money supply. Like, when we look at a lot of different, goods, whether that be homes or, vehicles or whatnot, you can measure that in like silver and gold and
Yes.
show that and see that, okay, well, actually, you preserve your purchasing power if you held gold that whole time, even through the bear markets. And so that was kind of something that I've been, trying to reconcile in my head as well lately. But just want to get your perspective on that, and then look at the copper chart because of the point you just made about news trading and everyone runs in, right? There was a tariff talk, and then it came down significantly.
That's right. 100%. So for a trader, anybody trading or buying and selling stuff, there's classifications, right? There's a scalper who's going to be in for minutes or an hour. Then the day trader who might hold a trade for a few days. And then it goes all the way up to the scale of position traders and investors, people who hold for long periods. But then there's stackers. A stacker essentially is somebody who just wants to hold either gold or silver. He's never going to convert back to fiat. No matter what the price is of gold, he's just going to keep buying it and every week. I knew a stacker where I used to work there like a decade ago. And every week he'd bring me to Kitco in downtown Montreal there. And I said, what are you doing? He's going in a little booth, and he's actually like, every week he was buying gold. Like, he says, I don't care. I'm buying ounces of gold. And I'll show you why it's important. Check this out. I love that you're measuring stuff in gold. We actually used this chart, and I think to pass, there was like a bill there in Florida or something for a Sound Money Act a little while back there. And this chart was they put it in the bill proposal or somewhere in there. This is from 1970, 68. Here is a single family home in the US priced in gold. So yes, there's ebbs and flows in that, but overall, you just need the same amount of ounces of gold practically to purchase back the same house, a single family house in the States. So it varies within a range, but over long periods of time, gold's going to protect your purchasing power, because if you had the ounces, you'll be able to, buy the same house again. But look in fiat, look at the houses. It just keep going up in price. That's why I tell people, they feel rich. Oh, my house, it went up. It's whatever, it goes up. Yeah, but your purchasing power went down, buddy. So your house in fiat, yes, it did go up, but gold reveals the truth, right? You got to price stuff in gold. You got to price stuff in ounces. You could do it for silver. Here's another one I did for here is the amount of, this is oil, the oil price chart, and fiat just keeps going up forever. And here is oil price in silver. So you see when you price it in something else, then you see that the barrel of oil is just oscillating within a very, very long-term range priced in silver. So these relationships of pricing stuff other than in fiat, changing that denominator is critical to see the truth of what's really happening. So while you might feel rich, while everything's going up in price, well, the price of eggs, guys, it ain't $2 anymore for a dozen, right? It's $6, it's whatever it is. Yeah. And they just get us there. It's like that stealth there.
Could you go back to that last chart real quick? The gold one.
Yeah, this one here.
This is a really good chart because like I was looking at like when you look at the 2000 to about 2008 period, like how many ounces of gold it took to purchase a single family home. It took a lot more because we were in the housing bubble at that time, and gold was starting to move up. And as you can see, as it moves up, the amount of ounces it took went down significantly by 2011. And so in the housing market, that was a blow off top too. So you could buy more house for your gold, with in the 2011 time after the housing bubble bust, and gold was at its all time high measured in fiat. And so looking at the ebbs and flows of like that, generally, gold's going to maintain your purchasing power, but it looks like there's opportunities that pop up where you can buy something different of value, like a home or whatnot, for less amount of gold, because if we look at, I think it was I went to the Rule Symposium in 2023. And I think gold had bottomed at, I think it was about 1900, 1800, something like that. That fall, it was a painful fall, and I went in buying more, but at that time, like it would have took me a lot more gold to buy a home, and then now since gold has risen significantly since then, it would take me a lot less gold to buy a home.
That's right. Yeah, there's these cycles within that where you could take advantage. And look, and this is a ratio chart. The fiat, the home price in fiat could go up and gold could go up at the same time. Like everybody is like kind of what's happening a little bit there. So you could have home prices going up, you could have gold going up, but this ratio chart could stay flat or go down depending if gold's outperforming the fiat denominated house price there along the way. But there are, yes, like traders within this, they could swap their home for gold, but you can't live, in a brick of gold. You still need to own a house to live in. But
yeah, for sure. We're filming in a house right now. We're not filming in the brick of gold.
yeah. But it's just to demonstrate, like gold is it's a fiat illusion remover. There, that's the way I see it. There, it sees the truth there. Gold is not supposed to outperform severely fiat. Gold is just supposed to showcase purchasing power destruction. That's its role, right? When I hear people, of course, gold over 200 years has underperformed the SPX. Yeah, it's normal. It's not built to outperform the SPX. It's just built to protect your purchasing power.
Yeah, exactly. Yeah, because if you would have kept that in fiat, then
I can show you the fiat chart, but everybody knows the fiat chart, right? It's top left to bottom right, right? It's
exactly over 97%. So let's jump into a couple other charts. We talked about copper briefly, but looking at the we had the news come out about the tariffs, 50% tariffs, and there was a big move upwards, and then it just kind of came crashing down. Could you go to the weekly chart? I think you're on the monthly right now. I mean, monthly still shows it, but
so we had a break. This is kind of nasty there. This is a false breakout, and sometimes, guys, these lines, they're not. It's areas of resistance, right? It's not that's why I try to use AI there to create lines. It's not really good at it because it's it's like human nature, right? It's not perfect. It's areas of resistance, right? Like I can thicken that up there. But essentially we had a breakout. It's like that was a breakout, risk on, there's no more problems. But what happens there often there, I've noticed, is whenever you have a breakout of this magnitude, and that's a breakout from 2021, like a very valid trend line, a failed breakout to the upside creates crazy moves to the downside after. Whoever got trapped here, everybody that went long, and then the price goes down, his or sell stops, and then after that, so it's called a false breakout with a reverse move downwards. And I don't know, man, until copper could regain like some mojo there and get back up here. Now it's below the 12-week moving average. It's below the 36-week moving average. It's below that rising trend line. Then after that, what you have to do, you have to zoom out a little bit more to see where there's potentially support. Now, you really don't want copper to go below. Oh, look at that line. My goodness. So you don't want copper to go below that there, because that means there's bigger issues. But I'll show you this there. I'm going to put my recession indicator on top there, just to show everybody what happens. Where's my recession? Okay, here it is. I'm going to change the color, make it green, darker, remove labels. Okay, here it is. Here's a 2008 one. You could sometimes see this happen because everybody's scared of recession, but often stuff flares up in a recession. And then after that, it's in the abyss of it. Look at that. Here you had a beautiful breakout in 2008 during the recession. Remember in the recession, they backfilled it. And that's another thing, guys. If you're waiting for the Statistics Bureau, Labor Bureau to tell you the recession, I asked ChatGPT this. They're always 8 months to a year and a half late to tell you about the beginning, but also the end. It's like, you can't follow these. But see, copper tried to break out here back in 2008, but then you got the market pressures like telling Dr. Copper, hold on, buddy. And look, it's a weight of evidence. Remember all these charts we covered, right? We saw that the 10-year minus a 2-year, and now copper's failing to break out. Even if the stock market's going up, it's omnious. It's omnious. It's not, here's copper just falling in the COVID. This is not pretty. This is not something you'd want to see there. So this is, it's a failed breakout to the upside for copper for sure there. So
yeah. So really quick. So so obviously people piled into this news about the 50% tariffs came out. People piled into the trade. And then that was clarified or walked back, however you want to look at it. And the price of copper just fell significantly. I mean, that's a very, very ugly red candle there. And but sometimes they overshoot, like they overshoot to the upside, they overshoot to the downside. And so do you think, looking at the RSI, I don't know if you got the RSI up, is copper oversold right now, where it could be an opportunity for a bounce?
Well, this is my distance from the moving average. So it's practically the indicator, which I found where it's closest to the price. It's just super close. It's just the moving average. How far is the price from the red line here, my 36-week moving average? So you're stretched when it's fun because you could do some TA on it there. I could do a line here. You see when it was that blow off here. Look how stretched we were when statistically we're in these rare occasions where, yes, it could be above the 36-week moving average to that extent, but it starts getting vulnerable. But on the downside, I could do the same thing. If I take the previous lows here to the downside, here's the low, like statistically, there's still some room for this to go lower. And here I might have a breakdown. Okay, yeah, it might be a more valid trend line here. There's still room for this thing to go down there, and it lost rising support. So you see that rising momentum as the distance from moving average indicator keeps going up. That means I'm going up, but I'm going up faster than the moving average. That's beautiful. You always want to be in an area where the money's coming in so much that you're not just going up in price. You're accelerating. You see here, like these explosions, you're accelerating upwards away from the moving average. These are the lower risk entries or position holds, because you're not fighting. You have enough money to go up, but you have enough money to go up faster.
Yeah.
So here, there's still room to move down, but I'll zoom out. This is called multi-time frame analysis. I'll show you the monthly. And check out on the monthly there. We never got, if somebody played that weekly chart there, that news, we never got a monthly defined breakout here. And that's the wick. That's the beauty of Japanese candles, is during the week, during the month, the price was all the way up here. And some people, oh, that's it. I can't, there's FOMO. I gotta buy this, right? The candle's all the way up here during the month, right? Because this was a green candle earlier this month, or in July. No, sorry, earlier in sometime in July. And then people FOMO in, but they don't wait for the close. You got to wait for the close. And then look at that. It's just crazy, man. Yeah. Bam, it closed in. So on the monthly chart, while on the weekly, you did have a breakout and it failed. On the monthly, we never got that breakout, which is, if you use the higher time frames, you're, it helps you remove some noise, but you also lose some speed on the breakouts, right? So it's a trade-off. But look at, so now it's just, there's no major breakdown yet. There's no breakout yet. It's a rising wedge, kind of dangerous there. Usually people anticipate it going down, but in bull markets, when these things break out to the upside, they could be very, very violent. And the distance from moving average, so here's my distance from my 36-month moving average, it's still okay there. It's still okay. So you gotta, if you ask me what my stance is on copper, I would say I'm neutral. I can't be bullish anymore because the momentum is really slowing down. I'm not totally bearish because there are important support. It's the market telling us we're not quite there yet. Look at that. Oh man, look at this in 2008. Look at that. Breakout, failure. So you got to be really careful when copper fails to break out there. There's something underlying that's in conjunction with all the other pieces of evidence. It's telling you things aren't as rosy as they are.
Yeah. It ain't sunshines and rainbows. So if we're looking at obviously recession, copper, in recession, there isn't much as much building. There isn't as much production. People are laid off. Oil price craters. All those different factors, right? And so, and we haven't necessarily had a real recession. We had multiple indicators, since COVID. And then we see on the COVID, the green line there, that it was almost like it was averted with the massive amounts of money printing and stimulus. The question of like recession has constantly been there. Obviously I'm bullish on copper, especially long-term AI data centers. There's so many fundamental cases for it, but there's always this boogeyman of recession that's in the background, that's haunting whether this is gonna happen or there's gonna be another multi-year period of waiting before you really start to see the massive moves.
Well, I'll tell you one thing. If you look again, here's a copper chart with the my gold versus is it the log scale? Log. Okay. So here's the copper chart, and here is the this one here, gold versus SPX. Again, that's the Rosetta Stone, guys. The Rosetta Stone is gold performance versus SPX, and the best runs in copper happen when they happen when gold is able to outperform SPX. So you have to see it from a trends correlation, not from a returns correlation. So as long as gold is trending upwards versus SPX, silver gets tailwinds, oil gets tailwinds, copper gets tailwinds, and that's when you have the greatest runs for copper there. It's when this is happening here, and often, well, always, it's instigated with a recession, and after that, every single other recession, the money printing, the total public debt. I could show you that chart. That's a quite revealing chart. I could show you after this. Is the total public debt. When there's explosions in government debt, stimulus programs, bailouts, all that stuff, it really on the recovery side of that, even when the stock market goes up, the commodities, they like it even more. They say, "Oh my goodness, you're destroying my purchasing power." I love it. So the good news is for copper is if gold can keep going up versus the SPX, that's great for copper. Seriously, like that breakout line here for gold again. When that happens, it's like even bearish news for copper is going to be bullish because the money's just going to be there. It's just going to be just coming in, ramming. Like people have to look at the miners. Did you ever see some terrible miners there, or like terrible ones, like the micro cap, the scams? They still go up in the bull market. It's like, guys, think clearly. It doesn't matter. Like good companies, they go down in bear markets, and bad companies go up in bear markets. Think about that. It's like the .com bubble. We like all the crappy stuff that went up in the .com bubble. So if you really want to make money, you got to look at the charts. I have to show you this debt,
Public debt.
the total public debt. They're a critical chart to understand where. Well, here, look at. Is that the good one? Where's that bringing me? To my website. Okay, it doesn't matter here. So this is the total public debt. So the government total public debt since 1966. I think we're way above. We're at 37 trillion here, 36 trillion. Mm-hmm. So even if it keeps going up and up and up, here's on the log scale. It's nothing out of the ordinary, right? It's not a hockey stick on the log scale. It's just a regular destruction of purchasing power that the government does. But look at this. This at the bottom here is the distance from the, I think, 6-quarter moving average of the debt. And look at that. Whenever there's an explosion in total public debt, recession, here, unwind, explosion in total public debt, recession. That's like, I could have overlaid on this the unemployment rate. It probably tracks to perfection this chart here. Unemployment rate starting to go up, print, debt. Look at that, recession. Look at this one. Beautiful bull run. As this deflates, the total public debt doesn't go up as fast. Brilliant bull run for commodity, for the stock market. Look at that. Bam, explosion. Unemployment rate goes up. The 10 minus the 2-year yields uninvert go up. And guess what? Total public debt explodes. Look at that. 2007-8 explodes. COVID explodes. So right now, it hasn't exploded yet. And probably that also, I could have overlaid the gold versus SPX chart. It looks practically like that. And it's a recurring theme, Daryl. You'll see that once. Look, memorize that gold versus SPX chart. And next time you look at charts, you're going to start seeing that they look alike. There's not that many chart patterns. There's these macro capital flows where here you see this, guys, from the 1970s to 1980 there. Guess what was going crazy here? Gold, oil, silver, copper, uranium, all that stuff was going crazy. The stock market sideways. As this deflates, the stock market just goes crazy. Gold, silver, and all that, they don't do so good. They go down, bear markets. And look, go up 2001 to 2010, 11. Guess what went up? Gold, silver, uranium, copper. I know I'm repeating myself, but so now once this explodes, it's a quarterly chart, so it's not, you can't really action on this, but eventually, if gold keeps breaking out versus SPX, that thing's likely to break out once again to the upside, and that will be more evidence that we're in a bull era for precious metals, etc. And the stock market is highly likely to go sideways, have multiple vicious bear markets, 40, 50, 60% bear markets, and just go sideways for a decade there.
A quick question. So what typically happens to emerging market? The U.S. stock market is super overvalued by all types of metrics. You got the Buffett indicator, multiple indicators saying that it's overvalued. But emerging markets, they haven't really had their run. I mean, some of them have recently, but they haven't had their run since the early 2000s after the .com bubble. We saw a big run in the emerging market companies.
I'm trying to find the emerging markets. I haven't looked at it in a while. Emerging markets, EM. I don't have a lot of data for some reason. Here it is. Okay, we're good. Yeah. So essentially, it tracks also the gold versus SPX ratio. So they do because they're based in a. There you go. Emerging markets. Not so much there, but they do a little bit better than they do great in. They did great here in the 2000s when the stock market was doing fine also on the recovery side. But there's no. It's not. I would have to research this one more, but there's no clear.
Yeah,
I would suspect that they would break out here to the upside if ever gold breaks out versus SPX. But I need data, Daryl. Where's my data?
yeah,
I don't
yeah,
have.
yeah, for sure. Yeah, it was interesting because I've been trying to understand like the emerging markets thing because
Here. Yeah, they're getting destroyed. The emerging markets actually, they've been getting just totally. This is emerging markets versus SPX. This one here, guys, and they've just been destroyed there. Even if gold is holding its ground versus SPX, so you see here they used to follow gold versus SPX, and on the way down it did, but it's it's just terrible. Oh my goodness.
yeah.
There's no reason to hold that emerging markets. It's going to take a lot of effort. My goodness, it's deep in the hole. There's no reason to touch emerging markets until, at the very least, this descending trend line gets broken above there. Wow.
Could you overlay the emerging markets over the dollar?
Over the dollar?
I've heard when the dollar goes down and it craters, then emerging markets have typically, I mean, their debts are denominated in dollars, and so typically that's more favorable for them. I was kind of wondering what that looks like on a chart.
Here's my dollar. Good. Yeah. Well, yeah. From a bird's eye view, dollars has been going up, and this has been going down there. Emerging markets going up, and dollar has been going. It bottom here. Yeah, there's some inverse trend correlation there for sure.
Okay, yeah,
but it's not. It's hard to action upon because even if the dollar goes down, this thing's still drastically underperforming the SPX. So there's practically no reason to touch this thing there.
Yeah, for sure. Okay, so let's just look at. We cover silver, gold. Let's look at uranium before we close out.
You want to do the miners or the metal?
Let's do both.
Okay, let's do it. All right. So uranium, the metal, man, has been in a crazy uptrend. The lower risk entry there was a little back here again. You see that? That's a monthly chart. Coiled and tight. The moving averages, they're just moving up out of the Ichimoku cloud. Higher lows, higher highs. That's what you want to ride. But now it lost a rising trend line here. That's not steep enough. It lost a rising trend line here on the momentum. So the distance, it wasn't able here to distance itself from that 36-month moving average as much. And check out what happened to the price once the momentum broke down. The price after that, it faltered also. So it's not out of the woods yet there. I can't, it hurts. There's a lot of damage when you get these blow off tops, and that's the log scale chart. When you get these moves there, Daryl, it's what you want to see there is, okay, that's a swing high. Maybe it's going to go here. You want some type of a new launch pattern there. Mm-hmm. And it's just not there yet there. It's going to need more work there so right now you had its bull run. It's consolidating, but with some more severe damage here. See it consolidated, but still above that 36-month moving average. So now it's this potentially could be a top, but you just have to wait there. And this will do a lot better once gold breaks out versus SPX there. This will have a much better chances of breaking out upwards though.
Yeah.
But I don't imagine it. I don't think this thing's going down here or there anymore there. It just where, people like buying early, but buying early, there's opportunity cost, right? So you can't buy here or there. You just have to wait until something materializes and goes up.
Yeah, and this is different than like the so there was a lot of moves in like the equities, the miners, the nuclear related stocks, especially with like all the news around AI data centers and then the executive order that was signed, which is another news driven, pump in the equities. So could we look at some of the equities?
Cameco?
Yeah, Chemical or URA or
Yeah. Well, Cameco is my favorite because if I do, look, I'll show you guys. If I do Cameco divided by URA, so I'm measuring Cameco's performance versus the basket of uranium miners. Look at Cameco's performance. It's like it's trending upwards against all the other basket of uranium. So if I want to make my life simple and I want to maximize my gains and minimize opportunity cost and all that, just go long Cameco there. It's like until it starts losing rising trend lines. It's very rare that the basket of uranium miners outperforms. If this goes down, that means uranium miners are outperforming Cameco. It's very rare that that happens. So if I just look at Cameco, Cameco. Look at that beautiful bull run. It had a beautiful consolidation here. So the low risk entries for Cameco, they were back here, breakout, beautiful base above golden cross, 12 month, 36 month moving average. Then a beautiful consolidation here. Then you had a second chance here to get in here. And now this is completely crazy there. Oh my, it's like an aggressive expanding wedge megaphone. Usually these things, well, when they break to the upside there, they're nice. So yeah, it's crazy there. That thing just broke out again.
Mm-hmm. And this doesn't reflect like the actual underlying commodity though. And so that's kind of like, it seems like it's a disconnect. Because uranium, you know, it was at over 110, and then you know, Chemical's breaking out versus it right now.
Yeah. So yes, exactly. So here you see Cameco here. It tracks pretty much the UX. Here I overlaid the uranium futures. So yeah, it tracks it pretty much the price, but yeah, of course it's not the perfect correlation. So now there's a divergence. So you got to say here, see here, there were divergences before where Cameco went up and the price of uranium went down. So what's going to happen next? Look, correlation, divergences, you can't, they're fun with hindsight, right? If like often people will say, well, uranium, the metal, it's doing a lower high. The price of the Cameco is doing a higher high. So you're saying this is bearish divergence. I'm not going to play Cameco. But what could end up happening is it's just a lag there. And after that, uranium continues, you know, based on that first chart, it finally does a continuation pattern breaks out and then follows to the upside, right?
Mm-hmm.
So you gotta be careful when stuff when the correlation doesn't hold. You have to use that more like a bird's eye view. Is uranium in an uptrend on the longer time frame? Yes. Don't worry about like the individual peaks. Is it an uptrend? Higher lows, higher highs? Yeah. Okay, good. And is Cameco doing higher highs, higher lows? Keep it simple, guys. Yes, it's an uptrend. And here it's not super stretched from the moving average. It just broke out here. Ideally, the lower risk entries were, you know, they were down here somewhere or here. But if somebody wanted to go in, it's not my optimal entry, but for people that are in, they could keep riding it until it closes below that 12-month moving average there. But yeah, Cameco is unrelenting for now.
Yeah, and a lot of my entry originally in the Cameco was at about $10. But
oh my goodness, down here.
Yeah, I didn't hold it that long. I didn't know what I was holding. But in recent years, the last year, you see those blow off tops, those three retests there. I mean, there you had the Japanese carry trade issue, you had the DeepSeek issue, and then you had Liberation Day. And so for me, when I see that much red in the markets, I typically go in buying and then, you know, ride it up because it's usually oversold at those points.
You mean here these wicks are at the bottom there, these huge lows there? Yeah.
Yeah, it should be April, September.
Yeah.
I think DeepSeek, I forgot when DeepSeek was.
That's exactly that. So that's September 2024. This is April 2025. And this one was February 2024 or March 2024 there.
Exactly. Yeah. So there's always opportunities to get in and ride those waves up. And typically you just got to know when to sell, right? But I mean, these things don't go up forever, right? You know,
no, they don't.
It's kind of like it kind of depends on your time frame of how long you're planning on investing in this. Do you think it's going to go up for the long term? And then we also know that these commodities are cyclical, you know, and so you have to factor that in too.
people, this is probably another emotional piece of advice. Are people, they need to, before they even put their money, they hit the buy signal. They have to know what type of trader they are. They have to decide: am I a position trader? Am I a long term investor? Am I a trader? Because it breaks my heart when I see somebody says, "I'm just going in for a fast trade," and then the price goes against them, and then they refuse to sell because it's complicated, tax loss season, whatever, and then they're trapped, and then they become long term bag holders, and it breaks my heart because that drains your emotional capital. Like, you went in with a game plan, you didn't respect it. And now, like, do you respect yourself? If you're honest and look in the mirror, it's like, then you realize that you were lying to yourself. You didn't follow your game plan. It hurts that. So decide ahead of time, what time frame, what are you? And it'll be much easier for you, because if you know you're going in being a long-term investor, then you won't care that it goes down 4 or 5% in a day, whatever, as long as the long-term uptrend's an uptrend, you won't let yourself impacted by that short-term volatility. And that's critical, because that will erode your emotional capital over the years, right? And you won't be able to hold it all the way to where you want it to hold it to.
Mm-hmm. Yeah, and that's the importance of like understanding also risk tolerance and risk management too. And so like if you're able to manage your risk, then you're not going all in on all in on a junior minor, right? And then losing everything, So you got to be able to manage risk.
Totally agreed.
Yeah. So Patrick, appreciate you for coming on the show. Where can people find more about you, follow your work, access your services?
Yeah, my goodness. Yeah, thanks. Well, look at Badcharts1 on X, guys. It's pretty much it's all good stuff, free stuff. But for more serious people there who want, for us to handle your chart requests and see the in-depth analysis and communicate with us, well, of course, it's like on NorthstarBadcharts.com. It's a membership behind a paywall. But of course, recently, like, we were currently having a 50% discount, so people could come and join up. And that's pretty much it there on X. All the free good stuff, a lot of content, a lot of value there. And there's always the behind the paywall for the members only there.
Sounds good. Well, you all heard it from Patrick himself. Be sure to hit the subscribe button. We love to have your support here at VRIC. And thank you all for watching. Thank you for joining us, Patrick.
All right. Take care, Darryl.